In 1999, a company called Pets.com was worth $400 million. They sold dog food online. They had no profit, no path to profit, just hype. 18 months later, Pets.com was worth zero, bankrupt, liquidated. Their famous sock puppet mascot ended up auctioned off online for $200. Pets.com was not unusual. Hundreds of .com companies vanished the same way. $5 trillion of stock market wealth gone in 2 years, erased from millions of accounts. Today, in 2026, the same exact pattern is forming again. Different technology, same psychology, same euphoria, same trillion-dollar warning signs nobody is paying attention to. I will show you the 4 signals that prove the AI infrastructure bubble is real, the exact dollar amounts at risk, and the 3 moves that protect your money before it pops. By the end of this video, you will see what almost every Wall Street firm is now quietly admitting in private, while telling you publicly to keep buying the dip. This is thinking stick. We do not do hype. We do the math until the math forces us to be honest. Subscribe so you do not miss what comes next, especially this year. First, let me show you the numbers, because numbers do not lie. Wall Street does, Twitter does, CEOs do, but the math behind a bubble always tells the truth, always. In 2025, the top 7 AI infrastructure companies committed over $400 billion to build data centers. That is more than the entire GDP of Singapore in one industry in 1 year. Microsoft alone announced an $80 billion AI infrastructure budget. Meta committed $65 billion. Google another $75. Amazon over $100. Every single tech giant racing the same race. That $400 billion assumes one thing. That AI revenue will explode fast enough to justify the spending. Spoiler. Current AI revenue is about $30 billion total. Read that again. They are spending $400 billion to chase $30 billion in actual revenue. The math does not work. It cannot work. Not without a miracle that has never happened in business history. Now here is where it gets familiar, because if those numbers feel insane, they should. But they are not new. We have seen this exact movie before. In 1999, telecom companies spent $500 billion laying fiber optic cable across America. They predicted internet usage would explode and pay for it all. They were right about the internet. They were wrong about the timing. Most of that fiber sat unused for a decade. The companies who laid it, WorldCom, Global Crossing, Lucent, Nortel, all collapsed into bankruptcy. Investors lost everything. The technology was real. The opportunity was real. The companies still went bankrupt because the spending arrived a decade too early. The math could not survive that long. Same pattern, new decade. Pattern interrupt. Now here are the 4 signals every bubble shows before it pops. The signals from 1999. The signals from 2008 housing, and the same signals quietly flashing across AI today. Signal 1. Massive valuations with zero profits. In 1999, Pets.com was worth $400 million while losing money every quarter. Today, every major AI startup loses billions while raising billions more. OpenAI is reportedly losing $5 billion a year. Anthropic similar. Most of the AI startup ecosystem burns more cash than it generates, while Wall Street prices them like they are already winning. Signal 2. Concentration risk. In 1999, the top 10 tech stocks were 30% of the entire market. Today, they are 40%, higher than any peak in modern financial history. When a handful of companies become the entire market, the market becomes one big bet on those companies. If they stumble, every retirement account in America gets hit. Same time, same direction. Signal 3. The wrapper collapse. Thousands of AI startups today are just thin layers built on top of OpenAI or Google. They have no real technology, no moat, no defensible business model. They charge customers $10 to access OpenAI's API for a service that costs them $9 to provide. The margin is razor thin, the loyalty is zero, the business is built on borrowed walls. When the funding dries up, wrappers vanish first, like the dot-com middlemen of 1999. Anything with AI in the name got funded. In a crash, only companies with real moats survive. Signal 4. The "this time is different" narrative. In 1999, people said the internet would justify any valuation. In 2026, people say AI will justify any valuation. The phrase itself is the warning. Wall Street has a saying. The 4 most expensive words in investing are "this time is different," because the human pattern of greed plus hype plus capital has never been different, not once. Now here is the part that should make you genuinely nervous, because the AI bubble is bigger than the dot-com bubble was, mathematically, measurably, by a wide margin. The dot-com bubble peaked at around $5 trillion in market value before collapsing. The current AI infrastructure bubble already exceeds that, sitting at over $6 trillion. With more pouring in monthly, if this bubble pops the way the last one did, $6 trillion of wealth could evaporate from American retirement accounts within 12 months. $6 trillion from a single sector, quietly, brutally. Now here is where it gets even worse. Because of how American retirement accounts work in 2026, most people have no idea how exposed they actually are right now. None. If you own an S&P 500 index fund, over 30% of your money is in 7 AI-heavy companies: Apple, Microsoft, Nvidia, Google, Amazon, Meta, Tesla. Heavily concentrated, heavily exposed. Most people who think they are diversified are not. They own the same 7 stocks, just bundled inside 100 different funds. The same AI bubble exposure through the back door, quietly. When the dot-com bubble popped, the NASDAQ lost 78% of its value. It took 15 years to recover. People who retired in 2000 saw their savings cut in half, sometimes more. If you are within 10 years of retirement, that is the math you need to understand. A bubble pop does not just hurt your portfolio. It can permanently delay your entire life plan, years of it. Now I want to be very clear about something, because this video is not telling you to sell everything in panic. That is bad advice, almost as bad as ignoring the warning entirely. Bubbles can keep inflating for years. Markets can stay irrational longer than you can stay solvent. Trying to time the exact pop is almost impossible. Most people who try get crushed badly. The goal is not to predict when. The goal is to be positioned before. So when it happens, and it will happen, you are not the one who needs 10 years to rebuild from zero. Here are 3 moves that protect you regardless of when the bubble pops. Each one specific, each one doable this week. Each one positions you for both outcomes simultaneously. Move 1. Diversify out of pure tech-heavy index funds. If your entire 401k is in an S&P 500 fund, you are betting almost everything on 7 AI companies. That is not investing. That is gambling. Add international funds. Add small cap value funds. Add bonds if you're within 10 years of retirement. The goal is not to predict winners. The goal is to not be wiped out by losers. The classic 3-fund portfolio, where 60% total U.S. stocks, 20% international, 20% bonds, survived 1999, survived 2008, and would survive 2026. Boring, beautiful, bulletproof, move to, build cash, not too much. 3 to 6 months of expenses in a high-yield savings account earning 4%. This is your stay-in-the-game money, your emotional shield against panic. When markets crash, the people who lose worst are the ones forced to sell at the bottom. Forced because they ran out of cash. Job loss. Medical bill. Emergency. Cash prevents the forced sale. Move 3. Keep investing through it. Do not stop your auto deposits. Do not pull money out trying to time the top. The single biggest predictor of long-term wealth is consistency through volatility. During the dot-com crash, the people who kept buying every month, even as their accounts dropped 50%, became wealthy by 2010. The people who panicked and sold never recovered. The market always recovers. Always. The question is whether you stayed invested long enough to be there when it did. Most people are not. They sell at the bottom and miss the rebound. Now here is the part nobody tells you. the part that flips the bubble from a threat into an opportunity. If you are young enough to wait, if you are disciplined enough to act. Bubble pops are the single greatest wealth-building events in modern financial history. Buying stocks in 2002 produced fortunes. Buying houses in 2010 created landlord empires. Same pattern repeats, always. Your job is not to fear the bubble. Your job is to be ready when it pops. Cash in hand, discipline intact, patience prepared. The bubble pop is when wealth changes hands. Permanently. The dot-com crash created Amazon. The 2008 crash created the wealth of every landlord under 50. The AI crash will create the next titan. But you can only buy the survivors if you are not broke. Let me show you the historical math, so you can see exactly what happened to people who got this right in 1999 versus people who did not. The difference is genuinely brutal. Investor A in 1999 had $100,000, heavy in tech stocks. By 2002, $40,000 left. By 2010, back to $100,000. 11 years just to break even. Investor B in 1999 had $100,000, diversified across stocks, bonds, international cash. By 2002, only $80,000 left. By 2010, $170,000, almost double. Same starting point, same 11 years, different strategy. One investor lost a decade of life. The other gained $70,000. The diversified portfolio quietly outperformed by 70%. Permanently. Now here is the deeper truth this whole video has been building toward. The truth almost no finance influencer will say out loud, because saying it loses them sponsors. Real talk. Wall Street wants you to keep buying, always. They make money when you buy. They make money when you sell. They make money when you panic. They do not make money when you stay calm. The best move you can make right now is the most boring one. Diversify, hold cash, keep investing, ignore the noise. The people doing this are the ones who will be wealthy in 2030. So here are the 4 moves to execute tonight. Each one specific, each one doable in 15 minutes. The bubble protection plan. Real implementation, not theory, not panic, just action. Move 1 tonight. Open your 401k or investment account. Look at your fund holdings. If more than 70% is in U.S. tech-heavy funds, you have a concentration problem, a real one. Move 2 tonight. Add an international index fund, Vanguard's VXUS, Fidelity's FZILX, Schwab's SCHF, any of them. Move 10 to 20% of new contributions there starting next payday. Easy. Move 3 tonight. Calculate your emergency fund. If you have less than 3 months of expenses in cash, and start building it this month. High yield savings account, 4%, untouchable, locked. Move 4 tonight. Set up automatic monthly investing, same amount, same fund, every month, no matter what the market does. The math beats panic every time, always, without a single exception. The AI bubble may pop next month, next year, or in 2030. Nobody knows. Your job is not to predict. Your job is to be positioned tonight. While most people are still ignoring it, most people will watch this video, get scared, then forget it within a week. They will keep their portfolios concentrated in the same 7 stocks. They will hope nothing happens. Hope is not a strategy. Hope is what people use when they refuse to plan. When the bubble pops, hope evaporates first. Strategy survives. Diversification survives. Discipline survives. Real planning survives. You are not going to be that person. Because tonight, you are looking at your real exposure and making at least one move to protect what you have already worked years to build up. Now here is the deepest truth of all. The one sentence that captures every single thing this video has been pointing at. Read it slowly, twice. Carry it with you forever. AI is not the bubble. The expectations around AI are. The technology will change everything. The valuations will not survive the wait. The people who understand that difference are the ones who win. Pets.com investors did not see it coming. WorldCom investors did not see it coming. Nortel investors did not see it coming. Every bubble pop surprises everyone except the people who quietly prepared. This time, the warning signs are public, the math is public, the data is public. You are reading them right now. The only question left is whether you act on them or hope they do not matter. If this video opened your eyes to something Wall Street will not tell you directly, drop one word in the comments below. Diversified, because that is what you are choosing to become. Tonight, bubbles pop, markets recover, wealth transfers. Your job is to be on the right side when it happens. Diversify, hold cash, keep investing, stay calm, keep thinking, stick. Like and subscribe so you do not miss what comes next.